name is Iris France, and today we're going to continue to talk about tax. In particular, I want to talk about the welfare analysis of a tax, meaning how the government lump sum tax is going to affect our consumer surplus and producer surplus. And to understand this, we need to review how to calculate or how to find consumer surplus and producer surplus on your diagram. So remember, your consumer surplus is the area below the demand curve, above the price paid by the buyer, and the base of the triangle is from zero to equilibrium quantity. Whereas your producer surplus is the area below the price received by the seller, above the supply curve, and the base of the triangle is also from zero to the equilibrium quantity. So we're going to see what happens to consumer surplus and producer surplus before and after tax. So before tax, we know the price paid by the buyer is exactly the same as the price received by the seller. It's P star. So in that case, your consumer surplus is the area below the demand curve, above P star, and the base of the triangle is from 0 to Q star. So that's the equilibrium quantity without a tax. So your consumer surplus is area triangle A, C, P star without a tax. So that's the consumer surplus before tax. What about producer surplus? That's the area below the price received by the seller, which is P star without tax, above the supply curve, and the base of the triangle is from 0 to the equilibrium quantity Q star. So you're looking at triangle P star CE. So P star CE. That will be your producer surplus without tax. Now suppose the government imposed a lump sum tax on the sales. Now from the previous video, we already learned that it doesn't matter whether the government taxes the buyer or the seller, the result is exactly the same. The most important thing is that you're going to find a wedge, that's the government tax dollar, between the price paid by the buyer and the price received by the seller. So you find a vertical distance between your demand curve and supply curve that gives you exactly $2, like that. So now, what is the new consumer surplus and new producer surplus? So we know the government imposed a tax and the consumer is going to pay price PB, producer is going to receive price PS, and the new equilibrium quantity is going to be QT. So your consumer surplus is the area below the demand curve, above the price paid by the buyer, which is above PB, and the base of the triangle is from 0 to QT. So you're looking at triangle A, B, PB. That will be the new consumer surplus. So I'm going to shade it with the red color. So your consumer surplus, as you can see, is smaller than before the tax. What about your producer surplus? Your producer surplus is the area below the price received by the seller. So below PS, above the supply curve, and the base of the triangle is from 0 to equilibrium quantity, which is QT. So you're looking at this green triangle area. So your producer surplus is equal to triangle PSDE. And notice that your producer surplus is also smaller than before. And you will ask, so where is this block? This block is actually government tax revenue. So for each unit for sale, the government collects $T. T is exactly between PB and PS, so that's $T. And how many units were sold? That's QT. So T times QT will be the government tax revenue. So it's right here, and you're going to see government tax revenue in the rectangular. And I'm going to shade it with the blue color. So this will be the government tax revenue. That will be this rectangular. So you see, if the government is not corrupt, the government is going to use the tax money to build roadways or national park or funding education. So we did not lose this block. What is really lost is this area that we lost. Nobody guessed that. So your Deadweight loss is going to be, I'm going to shade that in black. So this block is entirely lost. Your triangle BCD is the Deadweight loss, and nobody gets that. So you ask why? Why is it nobody gets that? Here is the reason. So we know that demand curve reflects the value of the buyer, and the supply curve reflects the cost of the seller. So you can see the value is B1 and the cost is C1. So before a tax, the buyer will be happily purchase a unit paying price P star and enjoy a consumer surplus B1 minus P star. And the producer will be happy to sell the unit because the producer's cost is C1 and the price was P star. But now with the government tax, because of the tax, the buyer will have to pay PB, which is higher than the value V1. So the buyer will say, forget it, I'm not going to buy this unit because the price PB is too high. So the buyer, this particular buyer whose value is V1, will be out of the market. What about the seller whose cost is C1? Well, previously, when the price was P star, the seller would be able to sell the unit and get the producer surplus, P star minus C1. But now, because of tax, the buyer can only take home PS dollars, and that's lower than the cost of this particular seller whose cost is C1. So the seller will say, forget it, because my cost is too high, it's C1. It doesn't make sense for me to sell this unit and go home with only PS dollars. So this unit of sale is lost due to a government tax. So neither this buyer nor this seller will get any consumer surplus or producer surplus after the tax. So we lost this unit of sales, and that's kind of bad. So there is a deadweight loss because of the tax. But without government tax, we know the government won't be able to provide us with education or with highways. So we still need the government to tax us. So we kind of have to choose the lesser of evil. So this is the welfare analysis of a tax. I hope this helps, and good luck with your studying.